Thank you for joining us for our third quarter strategy outlook titled Coming in Hot. Much like Doc's DeLorean as he re-entered in Back to the Future, economic data associated with reopening of the economy has been coming in hot. And no data point has been hotter than inflation. Our view is that yes, inflation is rising off the lows that we saw last year, but it's not running away. If you take a look at the parts of inflation that have been leading CPI in recent months here at the top of this slide, it's things that are transitory, things that have spiked because of dislocations related to COVID, and they're going to normalize, whether it be rental cars, whether it be hotels, airfares, all of those combined represent very little of wallet share, only about 10%. If you take a look, on the other hand, at what expenditures comprise the greatest part of CPI, collectively about half is shelter, food, and healthcare. And you can see at the bottom here, those have not been rising at extraordinary rates. So again, we think the dislocations are transitory related to COVID, and that's going to really subside as we get towards the end of this year and into the first quarter of next. Now, to get indication as to where inflation is headed, historically, the bond market has done a great job of predicting that. And to that point, on the next page here, we take a look at what rate of inflation is implied by bond futures. And as you can see at the beginning of the year, expectations for inflation started to rise as the economy started to pick up steam. But what's interesting, the yellow dot here indicates when we got those 2 months of very high inflation numbers, because we were anniversarying the lows of last year's recession. Year over year, this April versus last April, we saw inflation of 4.2%. May came in at 5% versus last year. That's to be expected because we're comparing this year versus the low of the recession last year during the COVID shutdowns. But it's interesting, you'll note that inflation expectations, in other words, the premium required by the bond market since then has actually gone down because the bond market knows what we know, and that these numbers that we've seen recently are temporary. And inflation expectations in the bond market are trending down towards the 2% target that the Federal Reserve has indicated that's theirs. Now, we've positioned portfolios for higher interest rates and higher inflation for many, many months. In fact, this next slide is one that we used last quarter. It shows what we've done in stock portfolios, bond portfolios, and asset allocation in anticipation of higher interest rates. If you look at the upper left, you take a look at what we've done within stock portfolios. Green indicates areas that have received capital. Red indicates areas that capital's been taken away. Stock market, we've reduced sector weightings in sectors that are adversely impacted by higher interest rates. Utilities, technology, and that money's gone into sectors that benefit from higher interest rates like financials and industrials. On the upper right, you see fixed income. In the bond market, we've taken money out of treasuries, redeployed that in corporates, again, an asset class that does best as the economy improves. And finally, and most importantly, asset allocation. As we did almost exactly 12 months ago, we reduced our allocation to bonds, took it down towards the lowest allocation allowed by guidelines, and redeployed that money in risk assets. And if our outlook for inflation is too Pollyanna and inflation surprises on the upside, what asset classes will do best? Real assets, stocks, timberland, agricultural property, the very asset classes that we're leaning into right now. So we feel very well positioned for inflation to pick up but not run away. Now, the Federal Reserve has been incredibly accommodative, providing an unprecedented amount of stimulus. The sort of expression on Wall Street about the Fed provides this punch bowl to the party, and when they take away the stimulus, the party ends. Well, here you see a timeline that we think is fairly realistic as to what's going to happen, because right now this punch bowl is spilling over. The Fed is pouring so much in that it's unnecessary at this point. The economy is moving on without all this Fed stimulus necessary. But what we think the Fed will do is spend the balance of this year telegraphing their moves, and all of next year basically slowly removing, sort of tapering is the term for purchasing fewer and fewer bonds in the market and letting interest rates rise gradually. And it won't be till 2023 that the Fed actually starts to raise interest rates. So again, it's going to be a modest gradual increase in inflation and a modest and gradual interest rate increase. To that point, if you look at our outlook for interest rates, they haven't changed since the beginning of the year. The yield on the 10-year Treasury at the beginning of the year was 0.92. In other words, less than 1%. Right now, as we stand before you, it's about 1.5% is the yield on the 10-year. We think at the end of the year, the yield on the 10-year Treasury will be somewhere between 1.75% and 2.25%. Again, like inflation, higher, but only modestly and not high enough to ruin this economic expansion. Now, speaking of economic expansions, the globe is opening up. Other economies are catching up to us in vaccinations. Here you see an estimate from Goldman Sachs segmented by country. And yes, the US and the UK has led in vaccinations. But the world is catching up to us. In fact, there was a piece in the Wall Street Journal today that indicated that at the current rate, the EU is actually going to pass the US in number of people that have had at least one vaccination within 3 weeks. So again, the world is opening up, and because of that, our allocations within international portfolios continues to be just like ours domestically. In other words, we're leaning into cyclical sectors that will benefit from an economy reopening and have great earnings leverage. And speaking of earnings, this market has been all about earnings because earnings have boomed. They've exploded off the low of last year's recession. Right now, estimates for this year on S&P earnings are $188, up from $140 last year. In other words, about a 34% increase in earnings. That's why the market's done so well, because earnings have led the way. And the story doesn't end this year, because next year, we still see earnings growth of about 10%. Taking S&P earnings up to approaching $210. Now, there's a lot of uncertainty associated with taxes. Clearly, taxes are going up. We don't know how much and when, but clearly they're going up. And taking a sort of composite of the average estimates on Wall Street, we think the damage to earnings will be, maybe take it down to $200 on the S&P. So again, even with the taxes, we still think we're going to see earnings growth next year, and therefore a catalyst for the market to move higher. Because after all, as we remind people every year in our outlook, as earnings go, so goes the market. And to prove that point, here we have a page that shows the last 12 months. The green bars indicate earnings on the S&P, and the blue line indicates the S&P price. Almost a perfect correlation. Earnings, as they've increased, the market's followed the way up. And if we continue to see earnings increase, which we think we'll see at a much lower pace, that is, we'll see equity prices reflect that. So to summarize, inflation is accelerating, but it's not running away. The economy is healthy enough to begin removing stimulus. The global economy is moving on from the pandemic. Earnings are exploding, and we remain bullish on risk assets, but bullish with a small b, because the returns are going to be much more muted than what we've seen in the last year. Thank you so much for your time and attention. Be well. Have a great summer, and we look forward to connecting with you in the fall.